In this video, I want to clarify some important details about what I consider to be one of the villains of the financial market nowadays. This villain is called leverage, and I want to give you a series of arguments to show you how leverage distorts and deceives people in the market, especially the ones who don't have a lot of experience and tend to believe anything at face value. For those of you that might not be familiar with the concept of leverage, it is simply the ability to artificially trade with money that you don't really have. That has the effect of multiplying both profits and losses. For example, if you have $1,000 and your broker offers you 100 to 1 of leverage, it means that you can have profits and losses that are proportional to an account that has $100,000. This leads me to the first argument about the evil that can open up when someone uses leverage without understanding it. When a trader first learns about leverage, he tends to learn one half of the story and ignore the other half that is not so convenient. The wannabe trader thinks that with leverage, his chances of making money quickly in the market are dramatically increased. It's obvious why such a trader thinks that. He believes that he will be able to trade as if he had $100,000, but only risking the $1,000 that he actually has in his pocket. In other words, he thinks that he will be able to make a lot of money starting with almost no money at all. This idea of extreme leverage reminds me a little bit of the idea of undiscriminated credit in the economy. When people have unlimited access to credit without having the ability to pay it back or collateral, the person starts to believe that she can own stuff that in reality she cannot. Both extreme leverage and undiscriminated credit create this powerful illusion that everybody starts off with the same opportunities, no matter how much money they have. That's evidently false, and in the case of leverage, it's easy to see that mathematically. If a trader can trade as if he had 100 times or sometimes 400 times the amount of money he actually has, the first significant loss will be enough to catapult him back to the beginning. That wouldn't happen with a trader that actually had a lot of money unleveraged. So even though a small trader and a large trader can theoretically have the same potential profits and losses, the small trader has a tremendous disadvantage, which is the lack of capital to sustain the heavy losses that will inevitably occur. It's almost as if the retail trader had a small powerboat and the large trader a large ship, and both the same amount of horsepower. The powerboat will move a lot quicker, but the moment they hit a storm, the powerboat will sink and the large ship will stand the massive waves. The analogy here is that the tool you need to stand the massive waves is not horsepower, it's a large boat. So that's a deadly mistake that many traders make. They think that horsepower given by leverage will allow them to stay on the massive and dangerous waves of the market, which will inevitably come. Once again, unaware traders try to use the wrong tool for the job. There is a much more cynic detail here that almost no one realizes, which is the motivation behind this extreme relaxation in the retail access to the financial markets on a global scale. There are two components to this. One is political and the other is economic. This almost free access to the global markets is not a matter of globalization. It's a combination of the necessity to have increasingly higher levels of liquidity in the markets and the dominant political tone in the world nowadays, which is postmodernism. The global markets need more liquidity for obvious reasons. The more people we have entering the market, the more we can pretend there is no problem with the economy. The markets reflect a healthy economy when companies grow, for example, not when there is a massive influx of people entering the market. This massive influx of people creates some sort of bubble that cannot be sustained, obviously. As far as the political side of this goes, globally speaking, we have the postmodern perspective, which is nothing more than a gigantic intellectual gymnastics to keep sustaining the old and obsolete Marxist ideas of the past. The main philosophers of postmodernism are Michel Foucault, Jacques Derrida, and Richard Rorty. And if you look at their history, you'll observe that all of them got their PhDs in philosophy more or less in the 50s, which was when the failed Marxist ideologies were facing the undisputable juggernaut of reality. Since they couldn't sustain their obsolete ideas with a scientific worldview, instead of changing their beliefs, they decided to attack science. To keep a long story short, postmodernism is anti-enlightenment with the goal of forcing equality of outcome in terrible ways. I'm saying all of this because the extreme ease of access to the markets and this illusion that anybody can be rich overnight is just an attempt to force equality of outcome, and it agrees perfectly with the postmodern tone because it uses the market economy to sustain a Marxist idea in a way. That's exactly what China does. Marxism has failed miserably there in the last century, perhaps even more than in the Soviet Union, so nowadays China has learned that the way to sustain these idiotic ideas from the past is by using the market against itself. That's why you see Chinese products in the Walmarts of the US. Anyway, that's a big discussion, but I wanted to make you aware that this problem actually goes deeper than what most people think. Another error of interpretation of this problem of leverage is that small retail traders believe that attempting to become a day trader is analogous to opening a business, and that's also not true. First of all, a business offers something in exchange for money. It can be a product or a service. A day trader just believes he's smart enough to pull money out of the market. He's not offering anything to anyone. That's the first difference. The second difference is that there is a clear distinction between equity growth and income growth. For example, when you open a business, there is a certain amount of capital invested, and the business generates a certain amount of income per month. Most businesses generate income without increasing their equity, meaning that the company generates income, but the company is not growing unless you reinvest the income in the business. In trading, people confuse these two principles. They believe that their income is going to come from the increase in their equity, which is absurd. It's like an empty factory that is expected to generate income just because the owner keeps expanding the building. Trading and investing are about increasing equity, period. It has nothing to do with generating monthly income, especially if you have a small amount of money. So, in summary, extreme leverage is basically forced equality of outcome aligned with the failure of understanding of simple principles of business. World history is filled with failed attempts to do precisely that in every level, and it didn't work not even once. I hope you were able to take something useful from this video. If you wish to learn how you can avoid the main traps of trading, understand the risk associated with the market, and ultimately learn what can be done to trade with your feet grounded on the floor with a scientific view of the markets, check out the courses available in the video description. If you wish to support the channel, please click the like button, subscribe to the channel, and leave your comment below. Thank you for watching. Take care.